Hello, welcome to Module 5, Lecture 1. In the previous modules related to ratio analysis, we have discussed and deliberated different ratios pertaining to different dimensions of finance to which a business is exposed to, specifically the short run orientation, the long run orientation, the efficiency of the business, the profitability of the business, then the market based orientation pertaining to profitability and so on and so forth. And we have discussed different ratios by establishing causal relationship between and among different items which are getting disseminated in financial statement and cash flow statement together. Now, with regard to the usability of financial ratios and the financial statement information, we all know that when you are going to talk about financial decision making, it is having more bearing with that of the future states of affairs of a business rather than the past or present state of affairs so far as the financial issues are concerned. In that context, it is imperative on the part of the users community to dig out what is going to happen in the business with regard to financial states of affairs in a future span of time. And when you are going to talk about future of the business, we are more or less going to have a predictive orientation to foresee or forecast what are likely to be the conditions or situations in a business in financial states of affairs. Now, ratio or financial ratios as the financial matrices are extensively useful while we are going to delve into the future financial states of affairs of a business by establishing causal relationship and at the same time by establishing relationship among and between different variables related to different financial dimensions of a business. And this particular lecture is going to address and accommodate different predictive orientation using financial ratios in order to unfold the dynamics of different financial variables and their movements in a future span of time. Now, before proceeding further, it is essential to have some elementary understanding with regard to the predictive models using financial ratios. When we are going to talk about predictive models using financial ratios, they are more or less using a blend of financial ratios and statistical methods to estimate future outcomes such as financial values, stock prices, profitability and default risk based on past and present financial data. Quantitative indicators from financial statement, for example, income statement, balance sheet and cash flow statement are the foundation of these models. Obviously, when you are going to make a journey into the future financial states of affairs of a business, we are there to start from the past as well as present as the base or the underlying premise on which we are going to move further into the unknown world of future related to finance so far as the body corporates are concerned. So, predictive models are making a blend of different financial ratios with that of the statistical techniques which are used to foresee or to forecast the futuristic movement and dynamics related to financial variables to which each and every business is exposed to. Moving further, when you are going to talk about predictive models, obviously the stakeholders community, the users, for example the internal users, managers, CEOs and all the top officials held responsible for different decision making activities. On the other hand, the external users, say for example the investors, the bankers, the financial institutions, the customers, the creditors, they are also equally inclined to know what is likely to happen and what are their magnitude, and at the same time with what probability they are going to happen. So, in that context, when you are going to talk about the usefulness or the significance of predictive models using financial ratios, definitely they are going to contribute significantly and succinctly so far as the financial decision making process at the end of varied users communities are concerned, because all these decisions are having a bearing on the future movement in those variables which are more or less talking about different financial aspects of a particular business. Now, to start with, we are going to have different significance associated with the use of financial ratios along with statistical models in the form of predicting the future states of affairs. As I said, they are heavily contributing. So, here some of the points have been jotted down. To start with, it provides early warning system for financial agony. When you are going to talk about the future of business in terms of finance, one thing comes to the mind of the stakeholders community: what is the extent and magnitude of financial creditworthiness in the future span of time. In other words, we may say, what is the likelihood of financial distress or the financial agony or the state of bankruptcy to which the body corporates are exposed to. By using predictive models, we can more or less scientifically quantify the likelihood of bankruptcy or the likelihood of financial distress to which the business entities are going to be exposed to in a future span of time. Then moving further, it also leads to data centric decision making. We all know that whosoever may be the person who is entrusted with the task of financial decision making, at times they are falling easy prey to their ego state, to their hunches, to their prejudice, to their premeditated state of mind. So, these are very common happenings with those individuals who are vested with the task of executing different financial decisions. But by using predictive models, the same individuals can have a rational approach by considering the outcomes arrived at as a consequence to predictive models related to different financial domains of a business. So, there is no need of going for financial decision making backed by hunches or desires or ego state. Rather, they can restrict to their approach towards data centric orientation, which is going to be more robust and rational so far as financial decision making is concerned. Moving further, it also leads to improved credit risk assessment. We all know, whatever may be the sector, the form, the size, the scale of operation of a business, every business is exposed to some or the other form of credit risk, which emanates from the use of debt capital in the business. Now, the predictive models can easily access and quantify the capacity and capability of a business to meet the near future short term obligations and far future short term obligations related to debt service and at the same time repayment of debt on a timely manner, and predictive models are contributing heavily. So, for example, when you are going to talk about the banks and financial institutions who are into the activities of extending loans for short term as well as for long term orientations, they are solely interested to know what is the credit risk to which a business is exposed to, because higher the credit risk, lower will be the financial credibility down the line in a future span of time. So, as because there exists an inverse orientation so far as credit risk and the financial obligation is concerned, it is imperative on the part of the users community to assess the credit risk in a scientific and rational manner, which leads to proper financial decision making. Moving further, it also facilitates portfolio management and appraisal. It is exclusively contributing towards the investors when the investors are into the task of committing their capital in different financial instruments, say in shares of companies, in debentures of companies, in bonds issued by companies. They are more or less using a blend of different financial instruments in order to diversify their risk, and they are always into the task of creating a portfolio. But we all know the financial environment is dynamic. It is not going to stay at the same condition for a longer span of time. Rather, it is always on the verge of change. So, when the financial environment is exposed to the changes, then obviously the investors are also equally required to respond to such changes by managing their portfolio, so that whatever happens in the financial environment, they will come out with their return irrespective of changes in the risk dynamics of the financial market. So, it is imperative at the end of the investing community to go for managing their portfolio and appraising the different aspects of their portfolio in a scientific and rational way, so that they are in a position to take decisions. And predictive models contributes quite heavily to predict the share prices, to predict the likelihood with regard to the different aspects of finance, say bankruptcy, say profitability, say the return associated with a bank in relation to the capital committed by the business, and down the line whether the company is in a position to observe the same magnitude of return in the future or not. Moving further, it also facilitates forecasting future performance. It is one of the fundamental outcome of predictive model using financial ratios, because when you are going to use different financial ratios in a proper combination, it contributes significantly and sensitively towards the aspect of future earning capacity of a particular body corporate. So, when you are going to assess the future earning capacity of a body corporate, definitely we are in a position to talk in objective terms what is going to be the financial performance of a company down the line in a future span of time. The last significance to justify why of predictive model and its use is it also facilitates unfolding manipulations and forensic analysis. When you are going to talk about the financial statements, the cash flow statements, they are always exposed to different manipulative practices, intentional distortions, subdued disclosures. These are very common in the corporate world, as has been experienced over the span of time. Predictive models are capable of curving on those, though not directly but indirectly, at the end of the stakeholders community by exposing the likelihood of distortions, the likelihood of manipulations in financial statements, so that the stakeholders community will take cautionary approach while making use of the financial information getting disseminated in the financial statements at the end of the body corporates. Moving further, after having a discussion on this significance, it is necessary to delve into the benefits which are going to accrue by applying and using predictive models into the financial decision making process. To start with, there is early risk detection. Obviously, when you are going to predict the extent or the likelihood of financial distress to which a business is going to be exposed to, it provides an early warning to all the stakeholders community, the bankers, the investors, the suppliers, the customers, the employees to take a note of that and accordingly take all possible steps so that the company will come out of that state of financial agony. Moving further, it also mitigates the prevalence of window dressing. We all know that financial statements are easy prey to window dressing acts. Now, by digging out the futuristic relationship between and among different financial matrices and using the same to predict the financial states of affairs in a future span of time is making the stakeholders community cautious with regard to the use and analysis of the same while they are into the task of financial decision making process. Moving further, it also provides the benefit of objective decision making. When you are going to talk about objective decision making, we are there to stick to all our financial decisions to have a strong foundation on which we are arriving at such decisions. Without having a strong foundation or underlying premise, all the financial decisions may end up in a state of failure and they are always subject to scrutiny owing to the simple fact that we are executing financial decisions backed by our hunches, backed by our prejudice rather than backed by data or facts related to future states of affairs which are more or less the outcomes of different predictive models used by the body corporates in the same domain. Moving further, it also leads to the benefit of portfolio optimization. Each and every investor is vested with the objective of going for portfolio optimization. So, it is essentially on the part of the investors to ensure that they are able to achieve the expected return what they are aspiring for, and at the same time they are able to diversify the risk to which they are exposed to by committing their capital in the corporate world. So, predictive models provides pre-hand information with regard to different financial variables related to body corporates, and thereby the investors are chalking out different strategies and policies so that they will optimize their return and minimize their risk at the same time. Moving further, it also provides the benefit of performance forecasting. We all know that when we are using the terminology predictive, it is directly related to the task of forecasting different financial variables and reading the future of business in financial terms. And there are different models which are in practice available to do the same and serve the stakeholders community to the best of their potentials. Moving further, all the regulating agencies are backed by different objectives and they are more or less serving the stakeholders community in a holistic manner. They are held responsible to ensure that the companies are disclosing and disseminating their financial information in compliance with the regulatory framework, and at the same time they are not indulged in different destructive practices, different faulty policies and different other unfavorable orientations which leads to agony at the end of the users community. So, the predictive models are also providing information to different regulating agencies, to the sovereign, the government, to perform and serve the users community to the best of their potential. Moving further, when you are going to talk about predictive models, we have discussed about significance, we have discussed about benefits. Now, we are going to delve into the pragmatic or realistic outcomes as a consequence to the use and application of predictive models at the end of the users community and at the end of the stakeholders community. To start with, one of the fundamental pragmatic outcome is it reduces defaults and losses. We can say for example that if I am an investor and I got access to the probability or likelihood of bankruptcy of a company beforehand while I am into the task of devising my portfolio. Obviously, so far as my interest is concerned, I will restrict myself to commit my capital in those companies where there is more likelihood of bankruptcy or where there is more likelihood of financial agony. So, by accessing the outcomes of predictive model and using it, definitely I am restricting myself from being into a state of default, and at the same time I am also restricting my extent of losses to which I am exposed to as an investor. Then moving further, when we are going to talk about the pragmatic outcomes, another one is minimizes human bias. Obviously, all the decision makers at different levels, may they be related to the middle level or may they be related to the upper level hierarchy of the organization structure, they are always carried away by their own ego state, by their hunches, by their premeditated mindsets, while they are into the foray of taking different financial decisions. On the contrary, the use and application of predictive models and the outcomes of the predictive models in lieu of different financial variables related to a future span of time obviously provides a solid platform to different decision makers not to take decisions on a subjective orientation, rather to make use of the facts as the outcomes of different predictive approaches and apply the same outcomes while arriving at different decisions related to different financial aspects of a business, may be related to mobilization of capital, may be related to commitment of capital in different liquidity projects, may be related to introducing a new product into the existing product line of, and so on and so forth. There are thousands of examples we may quote where finance and its involvement is very sensitive so far as the decisions related to all these facets of business is concerned. Moving further, it also provides one of the extensive outcome, that is, it improves planning and valuation. Obviously, when you are going to have pre-hand information related to future states of affairs of a business, we can better execute plans because plans have nothing to do with the present. It is always directed towards the future course of activities. So, if we can better read the future states of affairs related to finance, we can better perform the financial planning activities, and it is contributing significantly at the end of the users community, because though they are carrying varied objectives as the users of financial information, they are always resorting to different financial plans and which ultimately leads to financial decisions. So, the use and application of predictive models heavily contributes towards financial planning, towards valuation of companies in terms of finance, and so on and so forth. Moving further, it increases transparency, because normally when you are going to talk about future, there is heavy prevalence of subjectivity associated with different financial variables, but the outcomes of predictive model nullifies the prevalence of subjectivity by providing facts and data related to future financial states of affairs. And as a consequence, when we are reading the future financial states of affairs in a better way, obviously it provides transparency, and at the end of the users community, they are better off to take different decisions related to a future span of time instead of carrying the future state in a state of hedginess. Moving further, it also contributes towards maximization of returns. Nowadays, it is very easy to mobilize capital, but at the same time it is very complicated as a decision where to use or where to commit the capital mobilized in a business, because we are facing fierce competition so far as lucrative opportunities are concerned. So, we cannot afford to commit our capital in those projects or in those activities which is going to fail in terms of generating additional revenue, which is in proportion to the additional capital committed in the business. So, it is imperative on the part of the users community, specifically the financial decision makers, whether internal or external, to optimize their return by using the predictive outcomes of the predictive models, which provides information pertaining to different financial metrics, and the same may lead to an orientation where we are going to find ourselves in a state to maximize our returns irrespective of the vulnerability associated with the business ecosystem. Moving further, the last one is it stabilizes the financial system. Obviously, when there are more prevalences of bankruptcy, there is more prevalence of financial agony, the credit worthiness to which all the business entities are very much concerned, that is going to destabilize the financial system as a whole, because if there is heavy occurrence of financial failure, financial distress, financial agony at the end of the body corporates, that is going to dilute the financial system and its stability. The users community in general is going to lose faith and trust so far as the body corporates are concerned, owing to the simple reason that in the future states of affairs of the corporate world, it is very hazy. So, different predictive models facilitate the act of stabilization so far as the financial ecosystem is concerned by providing sensitive information related to different financial variables, which is going to be conditional on the future span of time. Now, we have discussed different essence of predictive models, starting with the concept, then the significance, then the benefits and the pragmatic outcomes. To conclude this lecture, we are there to say that in the absence of predictive models at the end of the users community, they are resorting to subjective approach towards financial decision making, and they are resorting to executing different financial decisions without having a rational orientation. But by using predictive models and using the outcomes of different predictive models addressing different financial domains of body corporates are going to definitely contribute significantly so far as rational and investment decision making is concerned. Thank you for your patient hearing.